It's great to have you all here. Tom, let me quickly pick up with you on the negative rates thing. Have you kind of taken a stance on this one way or the other?
Yeah, I think Steve nailed it. It's not going to happen, at least not now. There's no empirical evidence to show that it's helped in any of the countries that have been using it. Moreover, there's punitive economic outcomes associated with it, not the least of which is capital flight. I mean, we saw that quite clearly in Europe. So I do not believe that that's where we are going to be today. But look, I think if we learned anything from this Fed, it's they're willing to sort of toss away old orthodoxies. I mean, the Fed. This is a Fed that did not want to engage in buying credit, but here we are with the Fed now engaged in an IG program. So yeah. I think that things would have to get a lot worse, though, for us to go down that path.
Well, Jason, let me bring you in. It's your limited term income fund that's up this year, about 1% or so. How are you managing to generate that kind of return? Where are you investing client funds, and where would you start to rotate, if any rotation is underway now as we move into the back half of the year?
Sure. So what we're navigating here is obviously an unprecedented situation, but with a lot of echoes of times past. And that's clearly shown by the fact that the Fed is, in addition to some of the programs that Tom mentioned, is resurrected all of their old programs from 2008. The real issue here is that the Fed has pushed and regulators have pushed markets to be the lenders in the U.S. economy. So we are those lenders in our fixed income portfolios, and we found a tremendous number of different opportunities to step in from a liquidity standpoint when other folks were less willing to. So that's how we've been able to generate some of those returns. As this continues, and I think it will continue for some time, we're going to see ebbs and flows of liquidity. We're going to see ebbs and flows of opportunity. And navigating that's really key to investor outcomes, which is really what we're built to do as an active manager.
So maybe if you kind of put that in a little bit plainer speak for our listeners, sure. What kinds of income investments would you recommend right now?
Sure. So right now you see some of the basic blocking and tackling industrials, which are disfavored by the equity markets, to actually be survivors in the business. So we see some components, parts manufacturers, semiconductors were mentioned as and positively as a cyclical. Well, typically those are pretty cyclical business and command some pretty big spreads in this marketplace. In this market, you have a different situation. So something that was considered to be more risky because it tends to be more cyclical is being advantaged by the current economic and frankly, health environment. So you have to take what you know about the businesses that you look at as a lender and put that into the context of the current environment at both the individual and portfolio level.
Okay, Terri, I'm
coming to you. You saw United fail.
Right. No, I agree. United's deal falling through on Friday had a lot of people concerned about that. I want to pivot for a second, guys, if you'll stay right there, bring in Rick Santelli. We just had a bunch of 3-year notes go up for auction. Obviously very interested in how demand was. Rick, what can you tell us?
Well, demand I gave is a Charlie minus, a C minus, so a smidge below average. Remember, this is $42 billion of 3-year notes, the biggest amount ever auctioned. The rest of the auction series, 10s and 30s, also is a package, the biggest ever. Let's go through it. The yield, 0.23. Lowest yield at an auction for the 3-year note ever. We go through all the pricing. It's pretty easy on this one. Where it priced in relation to where the market was and the one issued was spot on. Everything else was just a little below average, whether it was bid cover at 243, all slightly below average. So we gave it a C minus, but that is nothing to worry about at this point. We're moving a lot of paper, and even though demand wasn't stellar, the longer maturities, which are coming Tuesday and Wednesday, probably are going to be a bit more interesting. Kelly, back to you.
All right, so lowest yield ever, and as a result, demand about a C minus. Rick, thank you, sir. We appreciate it. Rick Santelli. Terri, let me get back to you. I think that's like the second time you've had to, sit through some auction results. So you get the rest of the time here. Tell me, your fund, all asset fund, is down about 3% this year. The S&P is obviously down about 10% right now. How did you pull that off, and what's your advice to investors now?
Right. Yeah. Thanks, Kelly, for having us back with Sierra. Yeah, we've had a tough year, challenging year in terms of investing, but our strategies have really paid off. And I think it goes somewhat to Jason's point, your earlier guest, about really being tactical in this type of environment. When we just had Rick's report, there's all sorts of economic data that's been coming out. I mean, we've really paid a heavy toll for this coronavirus. And that is going to continue to inject volatility into these markets going forward. And so I think that the recovery that we're going to see is going to be somewhat in fits and starts. And our approach, which is essentially buy low, sell high, is to make sure and identify trends and rules that we have in place of when to buy and when to sell. We were in long treasuries all through March, long U.S. treasuries that really helped performance. And now we're completely out of that and back into risk on in the form of high yield corporate bonds, emerging market debt, preferred stocks.
High yield corporate bonds is interesting. You also mentioned emerging market debt, high yield stocks, but on the corporate bond piece of it, how important is the Fed's role here? Is it basically underpinning, your entire investment in the sector, or would you be willing to go out on that limb no matter what?
No, I wouldn't be willing to go into that limb no matter what. I mean, I think there's a couple of things that are going on. Yes, the Fed has absolutely been saying, I don't think they've been doing it, but saying that they would buy high yield corporate bonds, saying that they would buy muni bonds. And at its simplest, right, you just follow the Fed. There's a little bit more to it. We are seeing positive trends in that sector, and our rules are pointing us into that asset class and showing us that the trend that we're experiencing now is one that we can expect to ride for a little bit longer.
And finally, Terri, how long do you think this might play out based on some of where these valuations are? Are we talking, for the rest of May, for the rest of the summer, for the rest of the year?
Right. Hard to say. I mean, our trends are based on 6 to 9 month indicators. That said, this is a very different market than what we typically see. So we continue to watch everything on a daily basis. I do think that this recovery will be more of a swish than a V shape. Things take these stairs up and the elevator down, meaning they're a lot slower to go up than they are to go down. So hopefully this rides out for a little bit while longer, but we'll be watching it closely.
All right. Keep us posted. It's good to speak with all of you today. Terri Spath, Jason Brady, and Tom Porcelli. Thank you.